Speaking of the recession, these are latest numbers from the BEA. Fourth quarter GDP revised down to just 0.7%. Economic growth was much slower than expected in the first 3 months of 2025, while core inflation rose to start 2026. Commerce Department reported Friday, which is today. GDP, measure of all goods and services produced across the U.S. economy, rose at a seasonally and inflation-adjusted annual rate of just 0.7% in the fourth quarter. The first revision of the GDP reading was a sharp step down from the previous estimate of 1.4% and well below the Dow Jones consensus forecast of 1.4%. I wonder why the markets aren't moving down on this news. Maybe they've already priced it in. Who knows?
The markets don't trade. First of all, we're in a whole different world, David. You know, all that information is kind of priced into the market. Everybody kind of knew that the numbers that they were forecasting weren't going to be there. The firms, the money's already kind of set up ahead of time. You know, we're not in the days where you have to sit and wait for the announcement and the news to come out. Pretty much Goldman Sachs, JP Morgan, they've got a pretty good idea because you can track this stuff. If you know the numbers to watch going into it, what creates the GDP number, what creates the jobs number, then you can be pretty much prepared for it. We don't get those types of surprises anymore like we used to get. I mean, when I first started trading, when news was going to come out, we all had to stand in front of a 12-inch LED screen waiting for the news to hit the tape because it didn't come out because the internet was not what it is today. Now, the news is already out. People are already prepared for it. And of course, right now, with the lack of participation of the middle class who are not participating in this market other through potentially 401ks, you don't get to see the amount of action. So the controlling factors of the market, the people that are controlling it, they've already got it and they've already got the number. So you don't really see much movement. I mean, this morning's movement was almost zero on GDP. The market's hardly budged.
Okay. And so your assessment of the economy overall, given the data you've looked at?
I think it's horrible. I think that, other than the upper, let's say 10%, I think the rest are struggling. I think that their debt is getting massively higher, and it's being facilitated by the credit card companies that are allowing people to buy now and pay in 2027, which we know what a disaster that's going to be. Mortgage delinquencies, mortgage rates aren't coming down. I think we're very much overbuilt in a lot of areas. I expect a pretty nasty collapse once again. I expect something similar to 2008. I think the banks are over leveraged. I think the Federal Reserve is worthless. Their rate cut cycle, if you go back and look, they cut rates 5 times in the last 2 years, yet the 10-year notes have gone up 200 basis points. So they cut 150 basis points or 200 basis points. The 10-year notes went up 200 basis points. Where's the advantage for the consumer? Well, there's not, because the Federal Reserve is not in business to benefit the consumer. The Federal Reserve is in business to benefit the banks that own it. Okay. So I think that this is going to get very ugly. I think it's going to be a lot of struggling, not to mention all the jobs we're losing. AI is replacing lots of management jobs. Those aren't low-paying jobs. Those are high-paying jobs. And those people aren't getting other jobs anywhere else. They are going away and they aren't coming back. So another issue to deal with down the road.
If you liked this clip, then like the video and share it with your friends. And if you want to watch the entire full-length, long-form video, then check out the link in the description down below.